it's really important to consider maybe balancing out your portfolio, and that's exactly what I have done. And I got two of them that I bought that I think are going to do really well. I'm not talking about tech stocks. All right. It's been a stressful 48 hours, and not because the stock market's been doing bad, because it's been doing absolutely incredible. But as you can see, we're back in the old digs. So it's been pretty tough with some of the internet issues that we've been having down at the studio, but don't worry, we'll get those fixed. In the meantime, welcome to Own the Chaos. My name is Brad. The stock market is crazy and chaotic, and we made it our mission to help you own it. So if you want to see more content related to stocks, have a little fun as far as that's concerned, then please hit that subscribe button, hit the like button too. And today's video is going to be about Epicenter stocks. And if that doesn't sound familiar to you, I'm probably not surprised by that. But really what Epicenter stocks are stocks that have been hit the hardest, discretionary stocks, industrials, that sort of thing by the pandemic. And so I'm not talking about tech stocks. Notice I didn't mention anything about tech. Tech has been doing absolutely phenomenal since the pandemic, but some of these other laggards have been in materials, infrastructure related stocks, the discretionaries. And if you don't know what discretionaries are, it's basically like a miscellaneous category full of cruise liners and retail type stocks, those fun to do type stocks, those things that are fun to do. Those are the ones that we're looking at today. And I got two of them that I bought that I think are going to do really well. And I want you guys to let me know in the comments what you think as well on this. But before I get into the two that I've actually traded, I want to talk to you about what Epicenter stocks mean and who kind of really branded that term as far as these conglomerate of stocks are concerned. And so the guy who actually termed Epicenter stocks is by none other than Tom Lee.
Oh, you gotta go.
Now, if you've never heard of him, he's actually the head of Fundstrat. Tom Lee is a managing partner and head of research at Fundstrat Global Advisors. He's an accomplished Wall Street strategist with over 25 years of experience in equity research and has been the top ranked by Institutional Investor every year since 1998. Prior to confounding Fundstrat, he served most recently as JP Morgan's chief equity strategist from 2007 to 2014 and previously as a managing director at Smith Barney. His areas of expertise include market strategy, small mid-cap strategy, and telecom services. He's been doing this since 1998. Some of you haven't even been alive that long, and it makes me feel really old to say that, but I digress. He talked about these Epicenter stocks back in early March of 2020. If you recall, that's really right around when the market had bottomed, and he called that bottom almost to the day. He talked about those stocks way back then, and they have gone up, but they still haven't reached their full potential. And so then that got me to thinking, what kind of Epicenter stocks is he really talking about here? And so what I did here was that I actually went to Fundstrat's website, went to look at the 25 trifecta stocks that Fundstrat actually engages in, and these are the ones that came up. So the consumer discretionary area, we have Ralph Lauren, Norwegian, Royal Caribbean. We have a couple of financials, industrials, energy. We have ExxonMobil, someone's Marathon Oil. There's obviously a full list of energy stocks, and this is something that Tom Lee has been really emphatic on, is the energy sector. And then there's also real estate. Notice how we don't see any tech stocks here. Now, I know none of those sound sexy at all, but when you think about how much tech has moved and we're seeing interest rates rise and that tech actually is impacted by that, it's really important to consider maybe balancing out your portfolio, and that's exactly what I have done. I'm moving some stuff that have done really well since the pandemic and grabbing some of the stuff that's still beaten down that has a lot of upside still. And so that is why my first one that I'm going to talk to you about today is Under Armour. So I actually bought Under Armour and have continued to scale my way into this stock. My average, as you can see here, is at 1836, and I've scaled my way in. I always talk about scaling in and not trying to predict the bottom, but scaling into stocks that have a lot of potential here. We can come out to the weekly chart here. Now, this isn't one that is necessarily on Tom Lee's list, but it plays into that narrative of epicenter type stocks. It is discretionary. They sell, obviously athleisure. We know how well athleisure's been doing. I looked at Lululemon's most recent earnings, as that's the most recent company to announce their earnings in this sector, and I felt really really confident in Under Armour and the way that this is performing so far. You guys know, if you've been following the channel for any length of time, that I really do love Under Armour, and I've been talking and singing its praises for quite a while now. I just finally started to pull the trigger on this thing and feel really confident in where it's actually headed. You can look at this weekly chart and we can see that this is almost in breakout mode here. We get this above $19.50, $20 a share. This is going to continue. As you can see, over the last month or so, 2 months, it's been outperforming a lot of the tech stocks and certainly outperforming the NASDAQ in general, which has been hit so hard by rising rates. So if you want to protect yourself and hedge yourself a little bit against some of the tech that you might be in, I think Under Armour is definitely a great one to get yourself into. If you think about it, all the money that's coming in for the consumer, people like you and me, and are going out and buying stuff. We need to get new clothes because we're tired of wearing sweats all the time, being inside the house. We need new shoes. Your kids are going back and playing sports, all that good stuff. It makes sense for Under Armour to continue to move up. They've done some really good things to readjust their balance sheet over the pandemic, like getting rid of some of those crazy college contracts, such as the one with UCLA, to save themselves some money, to increase their bottom line, to increase their PE, and then increasing the stock price. It's usually how that works. So Under Armour, in my opinion, is going to be a great discretionary stock to own. Of course, there's plenty of other ones. Ralph Lauren, obviously, is what Fundstrat really believes in. There's plenty of other ones. Macy's, Bed Bath & Beyond. All those are really good discretionary stocks to maybe want to consider, but I settled down on Under Armour. So my second stock here is going to be ticker symbol EAF, Graphite International. And you might be asking yourself, what the heck stock is this? I've never heard of this one before. It's not one that I'm regularly familiar with, and I wasn't either until I actually started diving a little bit deeper into some of these Epicenter stocks, and it's all related to materials. Graphite is in just about everything, and more specifically, the demand for graphite comes when you're looking at a lot of the EVs. It's made in batteries. Graphite is going to be a huge mover, and it already has started, and I think there's still plenty of upside here. Looking at the chart, you can see that it's doing really well over the last several months, but there's still plenty of upside here. So this is going to have at least 20 to 25% upside in the short term. I think leading into the end of the year, we might see this breakout over this $15 a share mark. You can see that I have an average price here of $12.54. If this does end up dipping down below to the maybe $11.42 or $11.50 area, I definitely would consider averaging down there if it does end up holding that support. But you can see that this is forming a really nice cup and handle on the weekly chart. And I had to go all the way back on the weekly because it's been a minute since this has been up around here. But again, just kind of to my point about a lot of this rotation coming from tech and going into these cyclicals, materials, some of the stocks that just really weren't all that sexy are now all of a sudden becoming sexy again. Tom Lee seems to think that these value stocks and a lot of these discretionaries are going to act as if they are growth stocks and outperform growth this year and maybe even into next. Now, he's made some really compelling arguments as to why, and a lot of it just makes sense. He's done this for a very long time, and after doing a lot of my own research, I felt like making these decisions made sense too. But let me know in the comments what you think. Have you started to rotate some of your stocks out of tech, or are you digging your heels in and not budging from any of your tech stocks? I would love to hear from you guys in the comments below. So let me know what you guys think. Please make sure you're liking and subscribing if you got value out of this video. That's gonna do it for me, folks. Thanks so much for tuning in. As always, I will see you all before the bell, and B Smith is out.